Hello and welcome to KYC, show designed to give regular investors powerful, actionable insights into fundamentals of a single NSE-listed company every single day. Today, we are talking about Happiest Minds. This is an IT company that has been in focus, of course, on the back of earnings, but in general, we thought it'd be a good idea to take a look at this particular mid-cap IT company, which has, of course, been around for a few years now. What does Happiest Minds do? Well, it is an IT consulting and digital transformation company, and it actually looks at digital transformation. By that, we mean they help businesses modernize their technology and processes, and they often use cloud computing, data analytics, as well as AI. Moreover, it does IT consulting. It does get a good amount of its revenues from consulting as far as IT is concerned. In terms of the technology solutions that it provides, a lot of that will include something like application development and maintenance, cloud services, data analytics, cybersecurity, infrastructure management as well. In fact, in simpler terms, Happiest Minds helps companies use technology to improve their operations better and serve their customers and grow their business. So let's take a look at how the split of business comes through. Majority of its revenues comes from product and digital engineering, about half of, in fact, the revenues coming in. The digital business solutions will contribute to a little over another quarter, nearly a third actually. Infra management and others also contribute to the balance of the business. With that, let's take a look at the metrics that we usually address. And, as usual, we do take a look at the income statement, the balance sheet, return ratios based on the income statement, the balance sheet. We talk about the cash flows as well. And moving beyond just the financial statements, we also take a look at the shareholding pattern, how the stock has done, what the street is making of it, and of course, valuations at the moment. But to take us through a lot of these insights, I am also joined by Rucha, who's going to help us to wade through this whole process. So, Rucha, welcome to the show. Let's talk about the income statement. What are your observations here?
Definitely, Agam, thank you so much. Revenue is at about 1,600 crore rupees for FY24, posting a 3-year CAGR of about 28%. This is not a bad number. EBIT margin over here is at 21% as of FY24, posting a 13% 3-year CAGR. So what we can see over here is that that revenue 20% CAGR is not really translated to the 13% CAGR, whereas net profit over here is at 15% CAGR over the last 3 years. So not bad numbers, but disappointment in terms of revenue translating into margin is why we've given this one a neutral rating.
All right, so neutral as far as your income statement is concerned. While Rucha has mentioned that it has seen strong revenue growth, we are looking at operational metrics in terms of profitability to be not the best. In fact, for a company of this size, we've seen better profit metrics. So let's move on and talk about the balance sheet. Of course, this one is on a very strong footing. But, as is the case, usually IT companies have a pretty good balance sheet because of, very many reasons. But the shareholder equity stands at around 30 crores. It has a gross debt of around a little less than 1,100 crores. But as against that, the company also has cash reserves of around 1,260 odd crores. So all in all, it's a debt-free company. And because of the fact that it has such a large cash reserve, again, it's something that works in favor of the company moving in, which is why we'll give this one a thumbs up. But how are cash flows looking, Rucha?
Yes, so Agam, as you rightly mentioned, generally IT companies are cash-rich companies, and so is the case with Happiest Minds as well. The cash flow from operations stands at about 190 crore rupees as of FY24. And if we look at the kind of conversion ratio, 65% of EBITDA converting into cash flow is what we can see. So not a bad number in terms of cash, hence we've given a thumbs up. But what are the return ratios looking like, Agam?
So return ratios do look good. It's an IT company. Naturally, your return on equity and return on capital will be over 20%. And terms of Capital Minds, it's no different. The only issue here is that the return ratios are on the decline. So from 31% back in FY22, these return ratios are coming off considerably now at 22%. If it goes below the mark of 20%, then that's when, well, it could be a little bit of an issue. But for now, considering, we have a relatively steady steam, as long as the return ratios are not below 21%, that's going to, of course, be a positive. But let's move on and talk about the other aspects as well. And if we actually move beyond the financial statements, we can perhaps also take a look at how things are panning out as far as shareholding is concerned. So let's pull that up too. In fact, Rucha can take us through that.
You're right, Agam. So promoter and promoter group holding, as we can see over here, is 44%. So around 54% of free float is not a bad number. But you're like splitting that into FIs and DIs. FIs currently hold about 5.3%. As we can see, the pink color mark over here is the FI ratio, and around 6% is for domestic institutions. So not bit of a positive surprise over here, but 54% free float is not a negative as well. So we've overall given this one a neutral rating.
Right. Well, so neutral rating for, the shareholding pattern for the company. And at the moment, we're looking at promoter holding at around 44%, which may not necessarily be the highest as compared to many of the other IT companies. But let's talk about street credentials. And in terms of the kind of returns that we've seen for Happiest Minds, it's not been the best. And I'll tell you why. What's really happened through this course correction over the last 4 months is that the IT sector in general has held its own. But as against that, we're seeing Happiest Minds correct 8%. And in fact, in the last 1 year, we've seen a correction of around 17%. So in terms of price action, it's not been a favorable one. One might argue that, at that point in time, valuations were looking very, very, heady. Which is why we've seen a little bit of correction. That said, in terms of returns, not the best. So we'll give this one a thumbs down. But let's talk about street coverage then, Rucha. What is the street looking like?
So definitely, Agam, in terms of analyst recommendations on Bloomberg, there are 4 buy calls, 2 hold calls, and none sell calls. And the consensus target price implies a return potential of about 14%. But mind you, this recommendation is before the kind of third quarter update which analysts might come by tomorrow. So this is, this kind of bullish stance from analysts does not include the third quarter earnings. So that's a heads up over here. So overall, a thumbs up with 14% positive return potential, even after the company has underperformed in last 6 to 12 months. But naturally, valuation will be one of the issues which most of the companies in this kind of market are facing. So let's pull that up. And we see that Happiest Minds is trading at around 34 times its FY26 consensus EPS. This one is slightly on a higher bar. But if you look at the peers, we have both the sides. We have an emphasis trading lower than 33.5% at around 28 times. 33.5 times. Coforge trading at 40 times. So largely, Happiest Minds is in the middle of the acceptable valuation band. Not very expensive, not very cheap. Hence, we've given this one a neutral rating.
Okay, so there's an interesting thing out here about the valuations for Emphasis as well as Coforge. Firstly, in terms of public shareholding for Emphasis, it's only about 4% in terms of outstanding. Well, if you look at promoter holding, FI holding, DIIs, all of them taken together, well over 95% has been held just by promoters as well as FIs and DIs. That's as far as Emphasis is concerned. And for Coforge, if you look at how things are panning out, again, the free float won't be much if you consider the way things are panning out between FIs and DIIs. In fact, about less than 10% is held by the public at large. The balance, 90% is held by FIs and DIIs. The reason why I want to make a mention of this is that there is a scarcity premium both in case of Emphasis as well as Coforge, which is why there could be a little bit of a fluctuation with respect to price to earnings, a slightly higher price to earnings being assigned to them. On the other hand, if you look at Happiest Minds, 43% is out there with the shareholding, with the public. So that's where you're not going to have as much a scarcity premium. So clearly, that's the reason why we're looking at a discount. Of course, the other aspect that comes into play will also be the expected growth here on, which is why you'll see those price to earnings valuations at this point in time. Let's talk about the overall, picture in terms of your overall ratings for this particular company, and take a look at how things have fared as far as all the parameters that we wanted to address have come through. So it's been, a neutral stance for income statement, but a thumbs up for balance sheet, cash flows, as well as return ratios. And moving on, we have a thumbs down for street credentials, but besides that, a thumbs up for street coverage, valuations, picture, and shareholding, looking at a neutral stance. Moving on, the total rating, that comes down to around 5.5 out of 8. That's as far as Happiest Minds is concerned. But let's, before we get the management in, let's consider a little bit or in terms of a handful of other factors that we want to address. And in the medium-term guidance, Rucha, what can you tell us here?
Yeah, Agam. So this is the medium-term guidance in terms of constant currency revenue growth. The company mentioned about 30 to 35% of constant currency revenue growth guidance in the second quarter. But when we had a conversation with the management this morning, they said that 30% would likely be a little difficult kind of range to achieve, and hence they would likely settle at around 27 to 28, which largely what they are currently at. In terms of EBITDA guidance, they have guided about 20 to 22%, including other income. So this kind of stance is what they largely say. Now, let's talk about what kind of third quarter earnings did they report yesterday. In terms of revenue, it was up about 2%. Margin came in at 13.7% versus 13.2%, slightly below estimates. But if you can have a look at the stock is currently tanking about 1.4% down. So this clearly says that the third quarter earnings were not up to the expectations of the street. Moving on to constant currency growth registered this year, 28% year-on-year growth is what they have achieved in this quarter. Another important update which I want to highlight is the kind of acquisition that Happiest Minds had announced in April last year, that is April 2024. They had announced acquisition of PureSoft Technologies for a consideration of 779 crore rupees. Now, PureSoft Technologies is a digital engineering and transformation services solutions provider. The kind of synergies that Happiest Minds is likely to achieve is in the space of BFSI, banking and financial services, from which currently Happiest Minds gains a majority of its revenue. And another segment in which they are looking forward to have their more footprints is the healthcare sector. Healthcare sector largely posted kind of muted growth this time, but the management is likely seeing green shoots over here as well. And of course, BFSI is growing not only for Happiest Minds, but for other IT companies as well. And lastly, well, in terms of geographical presence synergies, the company will get nearshore presence in Mexico, Singapore, Malaysia, and Africa. So a lot of things in terms of inorganic expansion is what these guys are doing, Agam.
All right. Well, thanks for that, Rucha. And, in fact, let's get across to the management. My colleague Hira spoke to the management of the company, Happiest Minds, about their quarter gone by, and of course, the growth ahead. Listen in.
We have shown a year-over-year growth of about 28%. In rupee terms, it's about close to 30%. And in dollar terms, constant currency, about close to 1%. So yes, the street may have been expecting slightly better numbers on the constant currency growth, which we have shown at about 1%. But the fact of the matter is here, this time we had a fair bit of furloughs and holidays hitting us this quarter. After the acquisitions, we have grown deeper into BFSI as a segment, and we are seeing that BFSI has a pretty weak Q3, or the October, November, December quarter tends to be weak given the way the holiday structures, the statutory leaves, and those things happen. So we are coming to grips with that, but despite all of that, we took some revenue enhancement measures, and we have been able to grow at about 1% in dollar terms. All the other metrics of EBITDA, or be it operating margin, we have performed ahead of what typical expectations were, and EBITDA number is at 22.1% for the 9-month period, which is ahead of the guidance that we gave for 20 to 22%. So in all, revenue for the 9-month period and for the 3-month period, we are very close to the forecast that we had given to the market, which was 30 to 35%, and then we subsequently corrected, saying 30% is what we are going to target, and we are reasonably close to that. Next quarter, looking a little into the next quarter, we have closed this acquisition of customers and customer relationships of GADS Technologies in the Middle East market. We are looking to consolidate that, and that's almost 100% BFSI and infrastructure application services, application maintenance business. We are looking to grow into those accounts, cross-sell, upsell, and consolidate that starting immediately, almost immediately, because some of them are our existing customers, and we also have a reasonably good presence in the Middle East. So the consolidation benefits should see trickling in quite early. So we are looking at that and the organic growth in Q4 put together, trying to, the attempt will be to make sure that we try to reach the 30% number or hit that to the extent possible.
Right. That's an interesting one, because in the previous quarter as well, when we were looking at the 30 to 35% year-on-year constant currency growth for FY25, the ask rate in terms of the second half of FY25 was around 5.2%, right? This quarter, if you see in terms of the number, it's still on the lower side. Do you think you will be able to make up for that number, even to achieve the 30% guidance?
Yeah, so we did two things. One is we tempered the 30 to 35 to 30%, because, we thought we will be able to consolidate the acquired companies from the beginning of the quarter. For various reasons, it slipped, and we could only get about 40 days of revenues from both companies. And that's a significant number. So taking that into account, we said, let's not go too far away from what we have said, but let's keep 30 as the guideline number, the forecast number, because I was very clear that not to use the word guidance, maybe semantics, but I was sure that we should, these numbers have to come together, and it was too early. But we said we'll now try to achieve the 30% number. Compared to the 30% number, we are at about 25%. And if you look at it, Q2 and Q3, both these quarters, we have done 28% QOQ. So yes, we have missed the 30% by about 2%. And the attempt is to make sure that we try to cover up for the gap to the best extent possible. But in transparency, I think touching 30 may be slightly difficult, but we will be there in terms of 27-28% in constant currency.
Right. And in terms of the EBITDA guidance, I mean, it's 20 to 22% with other income. Current one, we are at around 21.7. It was interesting to see how in the previous quarter we were somewhere in that 28-29% kind of a range. Did this quarter actually see any impact on the back of wage hikes in the leadership team? Because that was something that we were watching out for.
I would take the reference of the previous year. We were at about 24.2% in the same quarter. 9-month period, 24.7. You bring out a very interesting point. One is, we have made investments into generative AI, GBS business, which is at about 24 crores, running at about 26 to 30% utilization. So I have said this in the last quarter itself, that in the first half of the year, we have made investments of about 1.5 million, approximately about 1.5 million. If you consider that similar kind of an investment going into Q3, it would be about 2 to 2.25 million. You add the new sales engine that we have added. That's something that we did, and that's an additional cost of about close to $250,000. The verticalization of the business, while it's supposed to give us a lot of impetus, it also adds some bit of costs. But keeping that aside, and the investment that we have to make into Artha Banking to make sure that it makes sense for the Indian markets and the other US markets that where we are going to take it into, we have made close to $2.5 to $2.6 million of investments in the financials up to the 9-month period of FY25. And just for that, and we are back to the 23-24% EBITDA, Hiral. So it is investments that we are making. It's a startup. GBS is a startup within Happiest Minds. Artha Banking is the non-linear growth platform that we have acquired from Pure Software, and we are taking to newer markets. the new sales engine. There is an overlay cost that we have taken to go deeper into existing relationships and get those new customers into which we can sell our services and offerings. So these investments take a little bit of time, but from a P&L standpoint, you can't defray these costs and match them with the revenues. We are getting hit on that account. That plus the compensation increase, which has been fairer than most of the other peers and market participants, has had an impact on our financials.
Okay, so with regards to segments that will lead you to achieve your guidance, what are you banking on? Because CV as a segment has been slightly muted, not only for you, but across the industry, right? People have been banking on the BFSI space right now. What is going to be your strategy?
Just look at our performance in Q3 as well, Hiral. You'll see that BFSI has really led the way. And so I would say that, and given the leverage we get from pure software Aureus, the capabilities, the customer base, and the Artha banking platform, I would say BFSI would be an area that we would be looking at to really help us accelerate our revenues. Another vertical or segment that has really come up well in the last year and a half is healthcare. We started reporting healthcare just a year back, and if you see, it's already around 14-15% of our revenues. And if you see on a year-on-year basis, we've demonstrated pretty good growth. A lot of interesting trends in this segment around bioinformatics, around newer type of medical devices, confluence of software and hardware in terms of various types of medical devices. And these are areas that, and overlay of analytics. So these are areas that are of strength to us. We have hardware practice, we have a very strong analytics AI practice, and healthcare vertical. That I would say is the second vertical that we would be looking at. And high tech, we're beginning to see some signs of, at least for us, if you see again, high tech has done well. And I think some of the strategies that we've been implementing of also targeting well-funded late-stage companies along with the larger tech players is beginning to show some dividends. So I would say these are three segments that we will be looking at helping us out during the quarter and probably into next year as well.
And with regards to the 500 crores that you did raise in July 2023 via QIP, how is the utilization on that front? Has it been for the acquisitions as well as on the Gen AI side? And if so, what's the kind of ramp-up plan that you have, and are you expecting large deals there?
The 500 crores that we had raised was for a combination of acquisition and meeting certain working capital and other requirements. So we are on target to meet those utilization targets set for us. But overall cash standpoint, we have deployed close to 800 crores in the acquisitions that we have made and the earnouts of the previous acquisitions. We are close to what 700 to 800 crores have been deployed. Despite that kind of an outflow, we still continue to carry about free cash balance of upwards of 500 crores. This I'm netting off, some of the overdrafts and received loans. But we are carrying about 500 crores in our books. That's a reasonable amount of cash balance for a company of our size. That's what we believe. But we should be able to, manage smaller acquisitions like the recent one which we did of the gas business in Middle East. Those are possible from our cash chest as well as our internal accruals. But if we want to do larger ones and acquisitions of, let's say, more than $50 million in size, we will have to look at options to raise capital or debt to fund those.
Okay, so from here on, growth will be driven inorganically or organically?
We drive. We don't split our growth on the basis of organic and inorganic. It's the strategy is to add capabilities, competencies. Like we said, we have added to our verticals through the last 4 acquisitions. Pure software was largely BFSI, healthcare, high tech. Aureus was largely BFSI and healthcare. whereas Macmillan was into edutech, and the most recent one, which we disclosed of consolidation of the Middle East business, is into BFSI and infrastructure business. So if you look at it, it's both fuel for further growth and consolidation of our existing capabilities and ability to sell it to those new customers. So, without splitting it, it will be a combination of both organic and inorganic.
Okay.
Well, that was the management of Happiest Minds telling us about the quarter gone by and what kind of growth we can expect going forward. But on that note, it's a wrap on this edition of KYC. Stay tuned to NDTV Profit.